We know that confirmation is needed in letter of credit as an additional undertaking in addition to that of the issuing bank when, yes, it is needed when the beneficiary is not satisfied with the creditworthiness of the issuing bank or in consideration of the country risks. Welcome back to our series on international trade finance. Today, we're diving deep into a crucial, yet often misunderstood, part of the UCP 600, Article 8, which deals with the role of the confirming bank and its responsibility after confirmation. Grab your notes, because this is a big one. Provided that the stipulated documents are presented to the confirming bank or to any other nominated bank and that they constitute a complying presentation, the confirming bank must 1. Honor, if the credit is available by a side payment, deferred payment, or acceptance with the confirming bank, B. Side payment with another nominated bank and that nominated bank does not pay. C. Deferred payment with another nominated bank and that nominated bank does not incur its deferred payment undertaking or, having incurred its deferred payment undertaking, does not pay. D. Acceptance with another nominated bank and that nominated bank does not accept a draft drawn on it or, having accepted a draft drawn on it, does not pay at maturity. E. Negotiate with another nominated bank and that nominated bank does not negotiate to negotiate without recourse if the credit is available by negotiation with the confirming bank. A confirming bank is irrevocably bound to honor or negotiate as of the time it adds its confirmation to the credit. A confirming bank undertakes to reimburse an other nominated bank that has honored or negotiated a complying presentation and forwarded the documents to the confirming bank. So what exactly is a complying presentation? In simple terms, it means the documents presented by the beneficiary, the seller, are exactly what the letter of credit asked for. They match the LC's terms, they're consistent with each other, and they follow international standard banking practice. Think of it like a checklist. If the LC asks for a blue pen, you can't present a red one, even if it writes better. Article 8, Sub-Article A is the heart of the matter. It states that if a presentation is complying, the issuing bank must honor. That's not a maybe, it's a must. This is the core promise of the letter of credit. It's the security the seller relies on. Once the issuing bank receives documents that tick all the boxes, their obligation to pay is triggered. Let's imagine a scenario. A seller in Vietnam ships coffee to a buyer in Germany under an LC. The LC requires a commercial invoice, a bill of lading, and an insurance certificate. The seller presents these documents to their bank, which forwards them to the issuing bank in Germany. The German bank examines them and finds they are perfect, they comply. According to Article 8, that German bank is now legally bound to pay the Vietnamese seller, regardless of any other issues. Now, what about the other banks? In the chain, reimbursement for the amount of a complying presentation under a credit available by acceptance or deferred payment is due at maturity, whether or not another nominated bank prepaid or purchased before maturity. A confirming bank's undertaking to reimburses another nominated bank is independent of the confirming bank's undertaking to the beneficiary. Sub-Article A also says a confirming bank, if one exists, must honor or negotiate. A confirming bank adds its own guarantee of payment to the LC. So, if our Vietnamese seller presented the documents to a confirming bank in Singapore and the presentation was complying, that Singaporean bank would have to pay and then get reimbursed by the German issuing bank. It adds an extra layer of security for the seller. Then we have Sub-Article B. This says that when the issuing bank determines a presentation is complying, it must honor. This sounds a bit repetitive, right? But it's an important reinforcement. It emphasizes that the bank's own determination of compliance locks in their duty to pay. They can't check the documents, say, yep, they're good, and then change their mind later because the buyer has a problem. The moment of determination is the point of no return. Let's go back to our coffee shipment. The German issuing bank receives the documents on a Monday. They have up to 5 banking days to examine them. Let's say by Wednesday, they finish their check and conclude everything is in order. At that very moment, under Article 8b, their obligation to honor becomes absolute, even if on Thursday the buyer calls them and says, "Stop the payment." The coffee beans might be the wrong grade. It's too late. The bank's duty is to the documents, not the underlying goods. This principle is fundamental. It separates the financial transaction from the physical trade transaction. The banks deal in documents and only documents. Article 8 ensures that if the seller holds up their end of the documentary bargain, they will get paid. It protects the seller from the buyer changing their mind or refusing to pay for reasons outside the documentary requirements. Now let's look at sub-article C. This part is about the confirming bank. It states that once a confirming bank determines a presentation is complying, it must honor or negotiate, and importantly, it must then forward the documents to the issuing bank. This makes perfect sense. The confirming bank pays the seller first, so naturally they need to send the documents to the issuing bank to get their money back. Imagine our coffee deal had a confirming bank in Singapore. The Vietnamese seller presents the documents there. The Singapore bank checks them, finds them compliant, and pays the seller. Article 8c says they now must send those documents on to the German issuing bank. Why? Because that's how they get reimbursed. The German bank, upon receiving the compliant documents, will then pay the Singaporean bank. It keeps the financial chain flowing smoothly. Think of it like a relay race. The seller passes the baton, the documents, to the confirming bank. The confirming bank runs its leg of the race, pays the seller, and then passes the baton to the issuing bank to finish the race and settle the payment chain. Article 8 ensures each runner knows exactly what they have to do when they receive the baton. So to recap the key players and their duties under Article 8, when a presentation is complying, the issuing bank must honor, the confirming bank must honor or negotiate, and a nominated bank that hasn't confirmed. They aren't required to honor, but if they do, they are entitled to reimbursement. This distinction is critical. A nominated bank is simply a bank authorized to handle the documents, but they haven't added their own guarantee. They have the choice to pay or negotiate, but not the obligation. However, the issuing bank and the confirming bank have no choice. Their obligation is absolute. Let's consider a practical example that ties it all together. A French company buys machinery from a Japanese manufacturer. The LC is issued by a bank in Paris, issuing bank, and confirmed by a bank in Tokyo, confirming bank. The LC is available for negotiation at the counters of the bank in Tokyo. Suppose Tokyo Mitsubishi Bank. The Japanese seller ships the machinery and presents the required documents, bill of lading, invoice, packing list, and inspection certificate to the Tokyo bank. The bank's experts in Tokyo examine the documents against the LC and find a perfect match, a complying presentation. Under Article 8c, the Tokyo Mitsubishi Bank must honor or negotiate. Since the LC allowed negotiation, they negotiate, meaning they purchase the documents from the seller, paying them the value of the shipment right away, usually minus a small fee. The seller is happy. They've been paid quickly. The Tokyo Mitsubishi Bank then forwards the documents to the Paris Bank. Under Article 8, the Paris Bank sees the complying presentation and must honor. This means they must reimburse the Tokyo Mitsubishi Bank for the payment it made. Finally, the bank in Paris will turn to the French buyer for payment in exchange for the documents which the buyer needs to claim the machinery from the port. See how Article 8 acts as the engine of the LC. It ensures that once the seller produces the right paperwork, the money flows from the buyer's bank through any confirming bank and ultimately to the seller. It's the mechanism that turns a set of documents into cash, providing security and predictability for everyone involved in international trade. Understanding Article 8 is essential for anyone working with letters of credit. It is the legal and procedural backbone that makes the LC a reliable payment instrument. It guarantees that a deal is a deal as long as the documents say so. If a bank is authorized or requested by the issuing bank to confirm a credit but is not prepared to do so, it must inform the issuing bank without delay and may advise the credit without confirmation. Thanks for tuning in. I hope this detailed breakdown of UCP 600 Article 8 was helpful. If you're involved in import-export, this is knowledge you can't afford to be without. If you found this video valuable, please give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss our next deep dive into trade finance. See you in the next video. Thank you.